What is going on, investors? Hopefully, guys are doing well out there. That is right. It is Friday. It's the end of a very volatile week on the stock market, and that means it's time for the FAANG Stock Recap Show here on the Investor Channel, where we recap all the major news of the week and the technical chart patterns from all the major FAANG stocks, including Microsoft, NVIDIA, Tesla, Netflix, and more. We've got so much to talk about. We better kick things off like we always do with Meta Platforms, otherwise known as Facebook. Started the week closer to $200 per share, ended the week closer to $190 per share. That was a 5% decline on Facebook shares. Now, a Senate bill is moving its way that could force Google and Meta to break up their ad business. This bill seeks to block companies that process more than $20 billion a year in digital ad transactions, and quite frankly, both Facebook and Google do more than that in a quarter, let alone a full year. This would likely also apply to Amazon at some point as well, from taking part in more than one part of the digital ad ecosystem. Because if you don't know this, if you're going to buy ads on Google, you're typically going to go to Google to participate in an auction system to buy ads on Google. It works the same way on Meta. And so I can see a little bit of this argument that maybe the fact that these companies are on both sides of the transaction really doesn't make this very transparent and maybe not very fair. Senators Ted Cruz, who's a Republican, I believe, from Texas, and you have Senators Amy Klobuchar and Richard Blumenthal, which I believe are both Democrats, are co-sponsoring this bill. The one thing that I will tell you, the fact that we've been doing this show, I think, believe it or not, I think we've been on for over a year and a half doing this FAANG Stock Recap Show. I can't tell you how many Senate bills and House Republican bills and House Democrat bills that have been proposed on these companies that have never made their way to the finish line. This obviously would have to pass the Senate. It would have to go over to the House of Representatives. It would have to get on the desk of the current president. The odds of something like that happening, especially when it forces the breakup of two of the largest companies in the world, I think is fairly low probability. And certainly when we look at Facebook's valuation at over $500 billion, if you start talking about breaking this company up, I think it's worth far in excess of $520 billion. So for shareholders, might not necessarily be the worst thing. Now, Meta is focusing on its business messaging with its WhatsApp cloud and its Messenger moves. Now, anecdotally, here on YouTube, I'm a big fan and a collector of luxury things like luxury watches. And there's a few channels here on YouTube that kind of chronicle that and do a nice job kind of creating content around luxury watches. And what I've noticed is every single one of those businesses uses WhatsApp almost exclusively to operate their business, both in the buying of these luxury items, but also selling them and connecting themselves with the consumer. So there's a huge opportunity here with Meta, as there's already billions and billions of dollars in commerce flowing through WhatsApp and Instagram that I don't think Meta really properly monetizes at the current time. And I don't think they provide enough tools to the people that use that. I think if Meta really drives into this, they've got a big market on their hands. And so I'd like to see the focus with Meta. That is something that I would be very bullish about when it comes to this company. Now, Meta's hiring discipline will pay off in cash flows, according to Morgan Stanley. So obviously, when we saw Meta's last earnings report a couple of weeks ago, they talked about how sales were down. They kind of guided down for their Q2. Profits were down, cash flows were down, everything was down over at Meta. But what they talked about is they were going to start to pull in on their hiring. They were going to pull in on some of their capital expenditures. And when we come over and look at 3 months cash flows over at Facebook, there's probably an argument here that they might be able to maintain these strong cash flows despite lower net income. You see, last year they had $9.5 billion worth of positive net income. This year it went down about $2 billion to 7.5, but notice their cash flows actually went up by about $2 billion from 12.2 up to 14. A lot of that had to do with this share-based compensation, but it also looks like maybe Facebook extended terms to maybe certain advertisers and had a lot more in receivable as well. So it kept their cash flows really strong. And if they have hiring discipline, well, I tell you what, they're obviously going to retain far more cash over at Facebook. Could be bullish from kind of a price to cash flow, price to earnings, price to sales type thing. I think there's a lot of investors that are starting to make that argument when it comes to Facebook, that a lot of the traditional valuation metrics are really making a lot of sense. And certainly if Facebook shows a lot of discipline and prints a lot of really strong numbers down here, it will validate those concerns. But you have to ask yourself as an investor, In these recessionary times, do you want a company pulling back on hiring? Do you want them just showing cash flow because the stock is going down? Or do you want them to just kind of ignore all that and just be aggressive and grow the company for the long term? Those are questions you have to ask yourself as an investor. Moving on to Apple, start of the week higher at 145, end of the week closer to 137. That was down about 5% as well. Now, Apple iPhone supply chain surprisingly resilient despite COVID-19 issues. This according to analyst Dan Ives over at Wedbush Securities. I tell you what, we get contradictory info on the supply chain issues and China's COVID handling of things, opening and closing of factories, opening and closing of the supply chain. I think we have to factor in for the coming quarters, it will be turbulent. It will likely be disrupted. It won't be 100%. But I think at this point, as we've seen all of these stocks continue to pull down, I think a lot of this risk is being priced into the stock already, quite frankly. Now, Apple nabs 51% of the North American smartphone market in Q1, aided by their new iPhone. Not necessarily a surprise, but I tell you what, if you have 51% of the North American market in a product where the vast majority of the adult population has that item, well, it's going to create a massive business. And obviously that has happened with Apple to an understatement. Now, Apple is to unveil a new version of their HomePod in short order. This is expected towards the end of the year. These are these smaller speakers. Now, anecdotally, I have two of these. I set them up in my living room. I absolutely love these things for $99. It's been one of the better purchases that I have made. It's really transformed the sound on my TV. My kids love it with their movies and TVs. I love it because I can have a speaker very close to me, have it turned down really low. I can still listen to my children. Highly recommend this product. Unfortunately, Apple did not pay me for this promo ad, but certainly if they want to send a check, we're more than willing to do that here at the Investor Channel. Now, Apple has shown its mixed reality headset to its board of directors. This was a really interesting report that came across earlier this week. In fact, it was yesterday. So this is saying that Apple has a product in that virtual reality, think like Oculus headset type thing, that they've already shown to their board of directors. And Apple's board of directors consists of a lot of executives and other people around tech and other companies out there. So the fact that they've shown this to them, essentially outsiders to the Apple ecosystem, they're on the board of directors, but they own and operate other companies and do other things. Well, that's really interesting. And it shows you that Apple is probably really close to this product. And I think that's what we're waiting for as shareholders over at Apple. Like, what's next? We know that the iPhone is just a dominant product, okay? We know that these HomePods, yes, they'll sell millions of these things, but it's not necessarily going to move the needle over at Apple. Could this virtual reality device actually do that? I don't necessarily think so, but it could usher in a whole new wave of technology and new products for Apple into the future. Now, Spotify dipped earlier this week as Apple Podcasts has announced a new distribution option. This will allow you to deliver either free, or there's kind of this move in podcasts to have premium episodes, ones that you have to pay for, using the provider dashboard in Apple or your own hosting provider. Now, currently, Spotify has kind of an all-encompassing thing where you kind of host and manage your own podcast within their system. I actually like that model, like a fully integrated model, but it's interesting that Apple is kind of pushing its way a little bit over in that space as well. Moving on to Amazon, start of the week at $2,263 per share, down like most of these stocks, down about 5% to $2,151 per share, just hanging in a tight range over at Amazon. Now, Walmart's Flipkart and Amazon is eyeing a stake in an Indian diagnostic chain, Metropolis. This is according to Bloomberg. Now, this Metropolis owns a chain of diagnostic centers across India, South Asia, and Africa. In India, they have over 3,000 locations. They're seeking about a $300 million equity stake in this. This would be a fantastic investment, I think, for any of these companies. Certainly Amazon getting into India. I know enough about the India economy that over the next 10 to 20 years, it's going to be a critical area of growth for companies like Amazon, Apple, probably Tesla as well. It's still an early market. It's still not a mature market, one that you can just jump into. But at some point, I think that's going to be a fantastic opportunity for these companies. I would keep a close eye on all your multinational companies. The more ground they can make in India, that's going to pay off, not necessarily over the next 4 or 5 years, but you start looking out 5 to 10 years, that's where the payoff is going to be. Walmart, Lululemon, and Wayfair slide as Target earnings weigh heavy on the retail sector. So obviously, if you watched our videos this week, I posted one about Walmart, I posted one about Target. Both of these companies decided to eat every bit of inflation in the most recent quarter. So while their sales increased marginally year over year, their profits slid off the map. We certainly saw that when we looked at Amazon's earnings a couple of weeks ago as well. This company, a similar type of thing. They actually lost money in their e-commerce business as margins just simply chewed up profits. They simply just did not raise their price targets. Now, I've had a lot of investors talk about this and say, hey, these companies should be raising prices, especially Walmart, Target, Amazon. They should be raising prices, but they are going to crush their competition over the next couple of quarters and next couple of years if this environment stays in place. I know that the Walmart CEO, I know the Amazon CEO will get on conference call and say, hey, we're trying to keep prices low for our customers. No, they are keeping their prices low to crush Kohl's, to crush TJ Maxx, to crush Ross, to crush every local grocery store from Ralph's to Rayleigh's to anybody out there. They are trying to destroy those businesses because they know they will be able to outlast those companies in the environment that we're at. I think it's a fantastic strategy. Whether or not it pays off for shareholders, how much pain in the shorter term in terms of deterioration of profits that we'll have to deal with when it comes to Amazon, when it comes to Walmart, when it comes to Target, those are things we're going to have to think about as investors. But this strategy of keeping pricing where it is, absorb all the losses, force your competitors to either do the same or raise their prices and ultimately lose their competitive advantage and lose customers to Walmart and Target in the future, I think is a great strategy. This is why you invest in gold medal winning companies, because even in bad times, they have the competitive edge, and oftentimes the silver and bronze medalists get hurt and injured along the way, making the other side an even easier gold medal for companies like Amazon and Walmart. But we'll certainly go through a rough patch as that works itself out. Now, moving on to Netflix, start of the week at $195, end of the week, down about 4.5%, down to about $186 per share. Now, Netflix layoff began with about 150 cuts. We're going to be seeing this across the board as we head into the summertime and early fall time here in the United States. You're either going to see evidence of direct cuts like Netflix cut over 150 jobs, or there's probably a fair amount of churn, especially when you look at Amazon employees and Walmart and Target. There's a lot of employee churn. They'll simply just not rehire the people that are quitting or going back to school or moving to a new job. Netflix deciding to cut ways with 150. This was just 1.5% of Netflix 11,000 employees. My guess, this was just kind of a warning by management over at Netflix. They took the 150 people that were just absolute dead weight at Netflix and made an example of them, saying, hey guys, if we put up another 2 or 3 quarters in a row, it's going to be a lot more of you that are losing your job. I like this aggression by Netflix. I feel sorry for these 150 people. I hope you land on your feet and find a new job, but this is business. It's not personal. I love this move by Netflix. We are seeing them start to take control of their employees, and that is what you want to see when it comes to these companies. Now, Netflix is losing new ground with long-standing subscribers. This is according to a report and data that is looking at cancellations among Netflix subscribers that have been with them for a long period of time. People are giving up on this service. I tell you what, there's bad news, all coming at Netflix. We've got under an $80 billion valuation on this one. The PE, if this is right, is close to 16. Certainly, we'd expect earnings in the subsequent quarters to be reined in a little bit. But boy, a lot of these companies are starting to look way more attractive. In the history of this show, it's starting to look as attractive as they ever had. Now, Netflix did agree to settle an Italian tax issue for over $59 million this week. This is after the company operated in the country for over 4 years without really paying any taxes. Italian law is requiring them to do that. Now, $59 million to most of these companies, and including Netflix, is not like a huge sum of money, but to Netflix, $59 million is a lot of money, and that will be tangible if they have to pay it all at once, or certainly in installment payments, will be tangible when you go and look at cash flows of that company. Now, moving on to NVIDIA, started the week at $173 per share. Boy, intraday, it fell right into our zone, south of 160. Intraday, you could have got this one at 157.55. If you didn't, don't worry. I think we'll retest that level and probably go even lower. End of the week closer to 166. That was about a 4% decline in NVIDIA shares. Now, NVIDIA has lost nearly half of its value since its peak. Is it time to buy? We'll discuss that when we get over to the technical perspective of this show. It certainly is pulled into an area where it makes a lot more sense from a valuation perspective. I mean, I remember when this PE was like 50, 60. Now it's closer to 30. We are on the eve of earnings with NVIDIA. We should hear from them next week. That complicates things a little bit, although we've heard from all the other chip makers as well. We'd assume NVIDIA probably will have a relatively strong quarter. We'll see how the market reacts when that day comes. Moving on to Alphabet, start of the week at $2,315 per share. End of the week, again, down about 6%, down to $2,177. This one was close to maybe a buy the dip opportunity today. Match Group gains amid store concessions from Google. Obviously, we have this battle with App Store, and really, especially like popular ones, like a match dating app, or like Tinder, or like Netflix, or like Epic Games, like a Fortnite. They're battling with both Google and Apple to not have to pay this massive 30% tax on any payment that is used when a customer transacts through their app. These companies want to process those payments on their own, pay a much smaller, quote, app tax, and then pay processing fees to whatever merchant provider they use. This is all tied up in court. My guess, here's what I would assume as an investor. I would assume Google and Apple's days of taxing these apps over 30% are over. And at some point, because of the competitive environment, at some point, a regulatory environment is going to force these companies to have to reduce that tax. You just have too much pushback, in my opinion. I also think for the ecosystem of the internet, probably wouldn't be a bad thing to reduce that fee. Music app Bandcamp to remain in Google Store amid pay system. Again, this is another pay system dispute. This is between Epic Games, which reportedly owns this Bandcamp. We're seeing it with Match Group. Just every week, we're seeing pressure on these App Store taxes. I don't think that's going to end favorably for Google and Apple, but I think to a certain degree, priced into a stock at least a little bit. Now, Google's purchase of Mandiant said unlikely to see China antitrust review. We're obviously waiting for clearance on this here in the United States as well. This was a $5.4 billion deal. Microsoft was rumored to be a bidder, or maybe even had acquired this company. Google stepped in, made apparently maybe a higher bid for it. This is a cybersecurity firm. My guess, Google's going to be allowed to make that acquisition. Now, we talked about this story earlier, how Apple nabbed 51% of the North American smartphone market in Q1. I think that's relatively expected. But what I've noticed is Google saw the highest growth, increasing its shipments over 380% year over year to 1.2 million units, up from 200,000 in a year ago period. Look, I don't really keep up with Apple smartphones. It could be that they didn't have a really great product or a fresh product this time last year. That's why these comps are up big. But I will say their product does look compelling in advertising. And if I was not an Apple user or one that liked their products, I think Google would be high on my list of the phone I would choose on the Android ecosystem. I personally don't think Google getting to like second place in the smartphone market in the United States, I don't think they're going to ever replace Apple. But if they can get to like a really high third place or second place in the United States, I don't think that's priced into Google stock. So there's certainly some upside if they were able to achieve that. Now, Advanced Micro Devices, otherwise known as AMD, partner with Google Cloud to help with chip design. We've seen this a lot with AMD. Since they acquired Xilinx, they've really gone on this partnership thing. They partnered with Facebook. Now they're partnering with Google. This, I think, benefits AMD far more than it does Google from a stock appreciation perspective and kind of percentage of revenue that will flow through these companies. Excellent, excellent news if you're an AMD shareholder. Now, Google's Russian subsidiary to file for bankruptcy following the seizure of a bank account. It looks like the Russian subsidiary of Google is going to go away. They're going to go bankrupt. All the employees are likely to maybe lose their jobs. Some of them, maybe if they have citizenship here in the United States, could maybe come back here. It's just a really sad situation what's going on. There are truly no winners when it comes to the conflicts that's going on right now. And I hope for humanity, it gets worked out in short order. Now, moving on to Microsoft, start of the week at 257. This one not down a whole lot, okay? Could be that we're exhausted some selling. Could be that the selling just was more accelerated in previous months and weeks past with Microsoft, but we ended the week closer to $252 per share. Now, Microsoft to make a huge compensation boost in an effort to keep top talent. So this is what I like about Microsoft. We talked at the lead, okay, how Facebook was cutting back. It wasn't going to spend as much. It might do a hiring freeze. I actually prefer this from Microsoft. Now, from a stock perspective, from a cash flow perspective, a valuation perspective, in the shorter term, might not show up on the balance sheet, might actually hurt Microsoft stock from a cash flow perspective, from a valuation perspective. Longer term, though, okay, when I'm thinking 5, 6, 7 years out, I'd much rather invest in a company in a recession. As we head into a recession, as we head into an economic slowdown, companies are boosting their effort, keeping top talent, are being aggressive in that environment. Recessions are when millionaires are made, and in this case, trillionaires over at Microsoft, as they probably will keep boosting their valuation despite the tough times. Moving on to the most volatile stock of the group, Tesla. Started the week at 700. Is that right? 758. End of the week over down 12.5%, close to $662 per share. In the after hours, Kathy Wood bumps Elon Musk Tesla for Roku as ARK's top holding. This is really surprising to me, but not necessarily unexpected, because if you've been following the channel, I've done some videos on it in the past. Kathy Wood's kind of been unloading some of her stake in Tesla because she's needed some liquidity to buy the dip on stocks like Roku and Teladoc and Coinbase and Square, some of these stocks that she bought very early on that are down 60, 70, 80, 90%. She's had to step in there and buy the dip. Well, she's had to step in with some of the money she's gained on her Tesla investment. My guess is this thing will flip-flop around a little bit, but it's interesting that now Roku is the flagship fund or flagship stock of the ARK investment fund, and Tesla slips to number 2. Tesla slips after Shanghai production recovery timeline is pushed back. And this is what I've talked about for weeks now. Shanghai factory over at Tesla on, then it's off. It's partly running, it's not running. It's at full capacity, it's not. We have to assume that in the upcoming earnings call at Tesla, which is still several weeks away, we're going to have to assume this is going to impact earnings, okay? We saw a dismal delivery number out of the China-made vehicles on our last show that we talked about. This is going to really impact revenues. This is going to impact profits over at Tesla. How well the company communicates that with investors really remains to be seen. If they communicate it very well, some of this news is already priced into the stock, but don't be surprised if there's a knee-jerk reaction on the upcoming earnings after Tesla reports maybe a slowdown in their growth due to these issues. Now, Elon Gate scandal as Musk denies wild accusations of harassment. Now, we'd have to expect this going forward with Elon. He's kind of put his neck out there buying Twitter. He's more recently said he used to vote Democrat. Now he's going to vote Republican. That is going to put a gigantic target on your back. Being the quote unquote richest person in the world is also going to put a gigantic target on your back. This will likely impact Tesla shares to a certain degree, as there's certainly people that are very, very, very politically minded here in the United States that will now never buy a Tesla, that will never buy anything Elon Musk is associated with, will maybe delete their Twitter account. But at the same time, always remember, here in the United States, you have people on the far left and the people on the far right. Okay, so you have equal sides of people on both sides of the political spectrum. They tend to cancel each other out. It's the like really sane and level-headed people in the middle that actually decide a lot of the elections, quite frankly. Elon Musk responds to Tesla's ESG boot amid calls for buyback. So look, Tesla was in this ESG, which I think is some kind of environmental sustainable company term that's been thrown around, but oil companies have really high ratings and a company like Tesla has low ratings. In fact, they got kicked out of the ESG thing. In my opinion, this is more, ESG is more like virtue signaling rather than real like investing in kind of hardcore actual environmental stuff. So that is not really a big deal. But you do have one of the larger shareholders at Tesla calling for a company to do a buyback, do $5 billion buyback of Tesla shares this year, $10 billion next year. The company has $18 billion in cash reserves, zero debt. We talked about that last time Tesla had a earnings call. We talked about how this company had $18 billion and not really a big use for it. So we've talked about like, what would they do? Would they go more aggressively into securing their supply chain, maybe becoming a miner themselves, buying maybe a battery company, maybe buying maybe even an auto company to gain access to more supply chains and labor and maybe even factories here in the United States and around the world? It'll be interesting to see what Tesla does with this cash. I don't think Tesla's use of this $18 billion, and then certainly if we start looking at 2, 3, 4 years, maybe it gets to $25, $30 billion in just cash reserves. What is Tesla going to do with that money? Certainly they could do a buyback. Theoretically, I guess they could do a special dividend or a regular dividend. But no matter what it is, I don't think it's really priced into the stock because there's a lot of people that just think Tesla's unprofitable. They're just this kind of a joke of a company or a meme of a company. But no, they are very, very financially secure, and a lot of their customers in the coming year, even with a recession, will probably still be very financially secure. I think this company will be interesting to monitor what they decide to do with those cash assets. I don't think that's priced into the stock. Another thing that you could argue is an upside for Tesla in the future. Talk about the Tesla chart here in a minute. I did want to start. There were a lot of requests to keep the S&P 500. As the S&P 500 keeps making these moves, I think we got to keep it in here. I tell you what, guys, we talked about how last week we thought we could have a little bit of a rally. We had the tiniest rally, like a 4 or 5% rally, and then boom, we slammed and made a new lower low down here, at least intraday over on the S&P 500. In fact, we slipped into bear market territory. I still think we can have a pretty strong rip your face rally close to the top end of this range. If we even get about halfway up, it's a 10% rally. All the way up, you're close to a 13, 14% rally. I think you take that time to sell because I still am not convinced that the drawdown over on the S&P 500 is over. So I think, yeah, absolutely. We could see some green candles over the next day, week, months, but I think it's followed by one more significant red candle down, and that will completely wash a lot of the bull case money out of this market. And that will be your real true capitulation moment and probably your great buy the dip moment. Now, the other scenario is we just put up a big red candle. I actually think this would be the easiest thing for investors to digest. If you see some big red candle pulling you down south of 3,600, which quite frankly is not that far down on the S&P 500, where you pull deep into correction, deep into a bear market. In my opinion, this is a much clearer sign that we're in a bear market. The market is reset, the valuations is reset, and you could start to acquire positions. When I talk about acquiring positions here on the channel, I'm not talking about buying 10 shares of Apple today and then never buying it ever again. I'm talking about nibbling over a long period of time. I assume most of you guys have salaries, or in other words, monthly cash flow that you're putting into this market. And a big, gigantic red candle to an area of support could create an awesome buying opportunity. Quite frankly, that would last maybe months, if not years. The more painful thing, quite frankly, as I think have a big rally here, you have a lot of people that will jump in the comments here and certainly on Twitter that's saying, hey, the worst is over, the bottom is in, only to show up one more big old red washout candle. We'll see which side of the market materializes in the coming weeks and days ahead, but I don't think I'm the only one kind of predicting either a pretty hard rally followed by a big drop, or just simply a big old red candle drop to the bottom of a zone. We'll see what happens in the coming weeks ahead. Now, today was a very volatile day. We saw stocks go up and down. Certainly Facebook not immune to that. We come over here, we're going to zoom into our price action. We're still just locked in this channel over at Facebook. When stocks are locked in this channel, you have to assume they'll retest kind of the top end of the channel, only to likely fail there and come back to the bottom of the channel and making another subsequent lower low on this one. If you asked me today where I thought Facebook could bottom out, quite frankly, most of these stocks look like they just want to go to the bottom of a demand zone, which at Facebook is down here at about $140 per share. Right now, shares at $193. That means I still think you've got $40, $50 in downside left in Facebook stock before this one really truly washes out. Now, remember, when Wall Street all sees a target, every single investor is going to look at the bottom of this zone over at Facebook and say, this is a great buying opportunity. Wouldn't surprise me if it comes up short a little bit. That would put you at about $160 per share. Not trying to call bottoms here on the show. Right now, I'm really trying to call places where it's like, okay, yeah, I would step in on that stock even in this downward channel, because that is the area from a technical perspective which would make a lot of sense. Moving on to Apple, it also has kind of pulled into this channel that we have here. Now we're going to turn this into kind of a red channel. You see here, we put up a big red candle. We were actually stuck in this zone up here, similar to Facebook, much higher range, but we were chopping around in kind of a downward channel. And just like the S&P 500, we broke through the bottom of it with Apple. Now, ironically enough as well, we kind of broke through the top end of our channel. And this was kind of give or take a couple of bucks, but it was kind of in that 140, 130 range over at Apple. We've pulled into this box. And so if you ask me, where do I think Apple is headed? I think it's coming all the way back to the bottom of this zone. We also have a longer term uptrend. If you take the bottom of this large drop that a lot of stocks made towards the end of 2018 into 2019, we had the first real significant tightening cycle over at the Fed. And then we had the Powell pivot where he went from tightening to back to kind of a loose monetary policy, or he really went from a kind of a loose monetary policy to an extremely loose monetary policy. I think we could have the same kind of pivot at some point again very soon, where the Fed says, hey, we've destroyed equity values enough. Inflation's probably going to go down because we have economic slowdown. We're going to pump the brakes on, 9 rate hikes planned for this year. We're going to maybe only do 5 or 6. Well, that would signal kind of a pivot in Fed strategy. That could absolutely reverse these markets. And we saw with Apple, it reversed around that time frame. And quite frankly, if you were to ask me now, if the Fed continues their rate hike cycle, I absolutely think Apple could pull down into this range south of $120 per share. Certainly not a bold call considering you're sitting at about $137 per share. This would be an area where I'd like to step in on Apple as well. Moving on to Amazon, in the same boat with Amazon. There's really nothing really new. We do have an area of support down here at about $2,000 per share. Again, give or take 4 or 5% on these numbers, because $2,000 a share, pretty large number. Also factor in that everybody is looking at the same chart. Everybody has these exact zones marked out. Again, plus or minus 2 or 3%. You might have some people step in. I would assume this stock continues to head lower. If you break lower than $2,000 per share, you've got some bottom resistance down here at about $1,600 per share. That would absolutely be an area I'd like to step in on Amazon. Moving on to NVIDIA, intraday, this one pulled into our green box. We might as well extend our green box out a little bit. People did not believe me for weeks. As I said, NVIDIA probably pulling back into this range. Here we are again, sitting right on top of it. If you were to ask me the trend and the direction I think NVIDIA is going, I think it's going to go lower. I think it's coming into this box. I think you'll have opportunities south of $150 per share on NVIDIA. I think those are decent buying opportunities. Moving on to Netflix, let's zoom in on the price action. This one's in a downward channel. It's kind of towards the top end of the channel. This one looks like it's having a little bit of strength for being in a downtrend. It's got a little bit of strength. Remember that we have this longer term uptrend that we keep adjusting to fit our narrative here on the channel, right? I'm joking, but I'm kind of not, but it is there. Okay. It would make sense for Netflix to hold this level. Keep in mind though, you do have earnings coming up, quite frankly, in July on this company. And so we'll see what happens between now and then, but certainly a volatile stock over at Netflix. Moving on to Google, boom, a big red candle down on this one. We'll clean up our chart a little bit here. Some of these lines are basically irrelevant at this point. Big red candle today. If you're asking me where Google is coming, it's currently sitting at about $2,175. I think we're coming down here to about $2,000 even. That would be an excellent place, in my opinion, to buy Google. If you have any kind of rally in this one, and this goes for all of these names, you're coming into overhead supply. You should have resistance up here at about $2,500 per share with Google. Moving on to Microsoft. This one just continues to go down. It's looking a lot like the NVIDIA chart. This one looks like it wants to pull back into the sideways consolidation zone. It's not a large one, but it's large enough given this sample space over $200 per share with Microsoft. You have to assume this is the biggest magnet in shares. That would take Microsoft south of $222 per share. If you get a rally in Microsoft next week, over the next couple of weeks, the next month or so, I could see this one coming back into the 275, 280 range. If you wanted to take profits on it at that point, wouldn't blame you one bit. Moving on to Tesla, looks exactly like the rest of these stocks. We've traversed sideways in a range. We're at the bottom of that range. We'd expect at some point this one to retest the top of the range. And quite frankly, a volatile stock like Tesla, if you have any bull move in markets heading next week, 2 weeks from now, a month from now, well, this one could make a huge run from the bottom of this channel just to get to the top. Again, if we make this move from the bottom of the channel to the top and you do it in relatively short order, you're still locked in this downtrend. You'd have to assume, even if you made that move, this stock would reverse back and then come and make a bigger red candle to a lower low. So here's the previous lows right now where the stock is sitting at 663. You'd have to assume we'd come down here and make a new low, probably at 600 or lower on this stock. But what I wanted to add was, if we have a rip your face rally on Tesla, it could be as much as 45%. And what you have to remember, if a stock makes a move like that, it doesn't matter if it's Tesla, but particularly Tesla, if Tesla goes up that much, even if it comes to about halfway and goes up 25, 30%, there are going to be so many people saying the bottom's in. The bear market rally was a pump fake. It's over. Time to buy the dip. And they might be right. It could be that this is the bottom and these stocks rally up to the intermediate highs and then eventually push all the way back up to the all-time highs, which would be an 80% move on this stock. And that would be absolutely fantastic if this happens, particularly obviously if you're long this name. But me personally, I'm going to take profits on a lot of these stocks if and when you get a rally on them, assuming that we stall out at the top of this range, put a big red candle, make a new lower low. I can take the profits that I made up here and redeploy them into the stock like this. If you don't want to churn your account like that, if you don't have experience doing that, if that's not something that is right for you, by all means, do what's comfortable for you. But I will not be buying any of these rallies. I will be selling stocks up into this rally, because you have to remember what the Fed will do if stocks make a massive move back to the highs. They're going to continue their rate hikes. They're going to continue doing quantitative tightening, which they haven't really even begun yet. So you're going to see a massive tightening in financial conditions if stocks move to this top end of the range. That is going to keep interest rates high. If you're going to try to buy a Tesla at a 6, 7, 8, 9% APR, that is going to impact this company's sales going forward. The only way I buy a rip higher is if the Fed comes out and says, hey, we're going to stop monetary tightening. We're going to go back to QE. We're going to drop rates back to zero. That's your cue to basically unload a clip and get back into this market, because that would likely shoot you not only back to all-time highs on virtually all of these stocks, but probably past the all-time highs. The odds of that happening in the shorter term, I think, are low. As we get into Q3, Q4, I think the discussion that the Fed will have to pull back on their quantitative tightening will become a major discussion, because in my opinion, while we might see some bear market rallies, they're going to be followed by even steeper declines down to the bottom of the channel, or simply investors are going to tap out and this thing is just going to drop like a rock in the coming weeks ahead. Either way, If you're my age and you're 40 and you have cash flow and you have a job and you have income, you should be dripping money into the markets as this thing continues to pull back. You can be very conservative. When I say drip, it might be 1 share, half a share, a tenth of a share, but you're building the discipline. If you can't buy this dip right here, you would not be able to buy an even bigger dip. So you're actually training yourself. When you're buying stocks on the dip, you're not trying to pick the bottom. You're probably going to quote unquote lose money in the shorter term. But what you're doing is you're training your investment mind. When stocks fall like this, when the market is bad, when the news is bad, everybody's telling you you're an idiot for buying. It's actually really hard to do that. And so if things get worse, the candles get worse, guess what? The noise and the criticism for you buying is going to get bigger and bigger. And the more you can train your mind that in recessions, you want to go on aggressive mode. You want to go in acquisition mode. You want to go in acquiring mode. You do not want to curl up like a rock and go in hibernation. If you're 60, 65, if you're in retirement, if you're using the money to buy a house, yeah, absolutely. You probably should be all cash. But if you're my age, even a little bit older, and certainly younger, in your 30s and your 20s, this is the time to dump every single last possible penny you can into stocks, not all at once, but develop the discipline in buying the dip. And as it continues to pull back, because that's what the probabilities are saying, continue to put more and more and more money in these markets. This is when you get rich. This is when your life change. I say that from experience. I was dead broke in 2008 and 2009, and I don't want to brag, and I want to seem humble, but things are way, way, way better for me financially now than they were back in 2008 and 2009. And it's because I piled my entire net worth in the stock market during these days. I've been here before. It can change your life, and I think we're on the precipice of that moment. Once again, be excited, develop a game plan, and I promise you it's going to work out very well for you down the road. Hopefully you guys enjoyed today's video. We'll be back again soon with lots more. Have a great weekend and good luck with your investments.